So guys, as we pick up from where we took off on last week, what I want to go through are some highlights of what we talked about last week. We talked about the effective tax rate and the statutory tax rate, and then we also talked about the marginal tax rate later on in the chapter. Know those. And also know that recognizing revenue and expenses for financial purposes it's gonna be different than how we recognize revenue and expenses for tax purposes. We're gonna go over some of the ways I want you to know about and that will be tested. There are gonna be a lot of others we're not gonna be tested on. Accounting issues. There are temporary differences. Sometimes for financial accounting, we may report revenues or expenses in one period, but for tax purposes, they get recorded in another period. Ultimately, they're going to be recorded and it's going to all wash out in the end. But the timing is the key. Timing relates to temporary. Temporary timing. Then we've got, and that results in, when we have temporary differences, it can result in a deferred tax asset or a deferred tax liability. We know that deferred tax assets mean we paid more taxes today than we will in the future on an item. A deferred tax liability is we're going to have to pay more taxes in the future than we did today. Know the differences. Be able to, just like I'm going through problems where you're having to be able to understand what would constitute a deferred tax asset or a deferred tax liability. Then we have something new here called permanent differences. These permanent differences, such as municipal bonds, okay, they will always be recorded as income for financial accounting purposes, but will they be ever recorded for income and tax purposes? Anybody? Did anyone just hear what we were talking about earlier? What was it? Never. Get it? Never ever. It's a permanent difference. It's not a matter of timing it's going to equal out. It's never going to be recorded. There are certain items that are expenses that might be allowed for financial purposes, such as penalties and fines. But guess what? With the IRS, do they care? They're not going to allow you to deduct them. Another example that's a permanent difference with travel and expenditures or entertainment and meals. For financial purposes, you can write off 100% of it. But what's the scoop for travel or for tax purposes, guys? Have any of you taken a tax class yet? With meals and entertainment, if you're not in the Department of Transportation, you can only, for tax purposes, write off 50% of it. There are scenarios for people in the airline or train. It's a different scenario, but don't worry about that. That is a permanent difference. Will it ever be where you can write off that extra? Never. Do you see it? It's not going to catch up in time. What's that mean? Temporary is timing issues. Okay? Okay? I don't know. That helps me remember things. Now, don't worry about operating loss, carrybacks, and carryforwards. Did I tell you don't worry about them? Okay? So we've got differences as it relates to financial reporting and income tax reporting. We're going to talk mainly about the temporary differences and permanent differences. What are we going to do about operating loss, carrybacks, and carryforwards? I might tease you on the test and say, operating carrybacks and carryforwards, A, happen this way, B, happen this way, C, don't need to know. A temporary difference is the difference between the tax basis of an asset for income tax purposes and the reported amount of the asset or liability for financial statement purposes. We went over all of these last week. Just look at them and go over them again. Usually with temporary differences, we're dealing with different periods of timing. Deferred tax liability is when future taxable income is going to be greater than future pre-tax financial income. As a result of that, we're going to have an obligation to pay a greater amount of tax. Therefore, we're going to create an accrued liability. And the deferred tax asset is the exact opposite, where our future taxable income is going to be less than our future pre-tax financial income. That's because our future pre-tax financial income is greater now. Okay? Excuse me. Our future taxable income is greater now because we're having to record it now, yet down the road in the future is when we're going to have to record it for financial purposes. So look at these examples. You'll probably see some of these again. That is the key. Do temporary differences create a tax-related asset, or do they create a tax-related liability? Then we started talking last week about the tax rates. If it's going to create a tax liability for in the future, we're going to need to know what the interest rate's going to be on that particular income. Do you remember how we kind of went through some of those problems? That's another problem we'll go through today. Okay. There may be future changes in tax laws or rates that we know about. If we know about those changes and we're aware of the income associated with them, we need to adjust our books now to take those into account. If we don't know about them, what can we do about it? Nothing. Until we know about them. Then we make the changes. Okay. A deferred tax consequent basically is something that we're going to involve future payment of taxes. We know we're going to owe the government that money, so we report it as a liability when we know it's being recognized. Again, we talked about what is a marginal tax rate. It's the last dollar of taxable income, how that's being taxed, okay? So the income tax is on a progressive level, so it's like a stair-step approach. So much gets taxed at a certain percent, and then once you hit a certain market, then that additional last dollar gets taxed at a new rate. The last dollar gets taxed at a new rate. That marginal rate isn't what all your money's being taxed at, it's what the last dollar is getting taxed at, which means the highest rate that you're dealing with. So know that permanent differences between financial income and taxable income will always reverse in a later accounting period or never reverse in a later accounting period. Never. Municipal income will never be taxed by the government, ever. It will always be included in financial income, but never in tax income.
Do you have to pay taxes on it if you put it on municipal bonds yourself?
No, you don't. Never. The reason they do that is because they're trying to encourage people to invest in local governments, and because the interest rate's lower, they don't make it taxable, okay? So this provides you with the three types of permanent differences. When there's non-taxable financial accounting revenues that are never taxable, such as municipal bonds, There will be non-deductible financial accounting expenses that are not deductible for financial purposes, but, non-deductible financial accounting expenses that are recognized under GAAP, but never deductible for income tax purposes, such as penalties and fines. Then there's allowable tax deductions that might be allowed for income tax purposes, but do not qualify as an expense under GAAP. Okay, so there may be certain, let me think of an example. I can't think right now. But know that financial purposes don't allow it to be an expense, but for tax purposes, they do recognize it. So what happens here, the permanent differences cause the company's effective tax rate to be different than the tax code. So basically that effective tax rate is just the income tax divided by all pre-taxable financial income. So think about it. If there are municipal bonds sitting on the books of $100,000, but that doesn't need to be taxed by the government, okay? Basically, that effective tax rate is going to be our tax expense divided by all pre-financial income. That financial income's in there, those government bond interest, but it's going to lower our effective tax rate, isn't it? Because a lot of that money isn't taxable. So know the various types of rates. Do not worry about operating loss carrybacks or carryforwards. We're not going to be tested on them. Okay? Do you hear me? As we relate to balance sheet presentation of liabilities, we are going to show deferred tax liabilities. We're not going to get caught up into the fact some are going to be treated as current and non-current. The most we're going to work on is determining what that amount will be, the total deferred tax liability. Guys, in a way, think of it like notes payable, or notes receivable. Sometimes there's the current portion that will be paid in the period that's treated as a current asset, and then usually all of the note receivable is going to be a long-term asset. Do you guys know what I'm talking about? But the amount you know is going to be due in that period can be treated as a current asset. I'm not worried about financial statement disclosures. Really, the key of what we're focusing on relates to what I've gone over, okay? The one thing I'd like to do a couple more problems on relate to determining the effective, or calculating the interest rate related to temporary differences. Any questions before we start? How you guys doing? Yeah? No? You guys okay? So, we were in, what is the last problem we went over? We didn't finish one?
Yeah, it was 1812.
1812? Is where we were talking about the pre-tax, or okay, so
It was permanent or temporary, and then liabilities last.
okay,
And we didn't do part F yet. We were in part 1, and
we didn't finish part F.
we didn't finish part 1.
Did we just? Oops, wrong one. Okay, what page is in the book, guys? Is
1847.
sorry about that. Okay, thank you.
And then we were at number 1, part F.
Number 1, Part F. How are we doing, guys? We doing okay? Okay. So, we're going to just start here just so I don't confuse everybody. Braun has completed its first year of operations and has a number of differences between its pre-tax financial income and taxable income. The differences at the end of 2013 are as follows. Braun recorded $7,000 of interest revenue on municipal bonds during 2013. Is that going to be a permanent difference or a temporary difference? Permanent difference. And in this case, I'm going to number 2 here. For each item, determine if it initially results in pre-tax financial income being greater than or less than taxable income. So if we have $7,000 of interest revenue in municipal bonds, we know it's taxable for financial purposes, not for tax purposes. So will it be, is pre-tax financial income less than or greater than taxable income? Greater than. Next, 15,000 of installment sales were recognized in income during 2013. They're expected to be received during January of 2014. So let's think about that. For financial purpose income, we had 15,000 greater in income than we had for tax. Okay? So our financial income is greater than or less than taxable income? Greater than. When we know that our taxable income is going to be greater in a future year, do we need to create a deferred tax asset or a deferred tax liability? Deferred tax liability, don't we? Does that make sense? So to answer the question, the financial income is going to be greater in this year than it is for taxable income, and we'll need to create a deferred tax liability. Okay? Next, depreciation on machinery totaled $28,000 using straight line depreciation for financial statements. Braun's tax accountant recorded $36,000 of depreciation on the company's tax return. So guys, is this a temporary difference or is this a permanent difference? Temporary difference. What are we going to do here? Are we going to have a deferred tax asset or a deferred tax liability? We're going to have a deferred tax liability because why? We're paying more taxes in this year. C, depreciation on machinery. So our tax, you're right, deferred tax liability because we're paying, our income taxes for this year are much less than what they're going to be in the future. Okay? And for that purpose is financial income greater or less than taxable income? Financial income is greater than or less than taxable income? Greater than. D, Braun was fined $3,000 for violating certain labor laws during 2013. Braun paid the fine during 2013 and agreed to ensure future violations would not occur. Is this a temporary difference or a permanent difference? Permanent. And in this case, is pre-tax income greater than or less than taxable income? Less than. We get to write off things on financial income we can't for tax purposes. Fielder Corporation has agreed to rent space from Braun in 2014. In December of 2013, Braun received $7,500 from Fielder in advance for rent. Is this a temporary or permanent? Is this going to be a deferred tax asset or a deferred tax liability? Why? Are we paying more taxes now than in the future? Or are we paying less taxes now or in the future? We're paying more taxes now because we're having to show it as income, aren't we? For tax purposes. But for accounting purposes, we get to report that revenue when it's accrued, when the rent has lapsed. So for purposes of financial accounting versus tax accounting, which one's greater? Which one's greater? Taxable income's greater. For 2013, Bronix reported $9,500 of warranty expense on its income statement.
What was that again?
For the rent space, the rent was recorded up front, okay? The rent was, all the money was given up front for a period of time. So for financial accounting, it's going to be treated as a prepaid rent, right? And then as you earn it, you're going to show it as income, won't you?
Greater than or less than?
That's going to be, tax income is going to be greater than financial income, because the financial income isn't going to be treated as revenue until we earn it or the time has lapsed. For 2013, Braun reported $9,500 of warranty expense on its income statement. The company's warranty liability at the end of 2013 was $6,250. Braun expects additional warranty costs to be paid during 2014. So in this case, are we dealing with permanent differences or temporary differences? Temporary. And what is happening here, are we having a deferred tax asset or a deferred tax liability? What? Think about this. We're showing a warranty expense right now on the books. It's kind of like that allowance for bad debts. We show that warranty expense, but when do we truly get to write off the expense for tax purposes? When we do the work, right? So it's a temporary, it's a deferred tax asset, and in this case, financial income is going to be less than taxable income. So what might be helpful for you guys to do, at least for me, is come up with a chart. Taxable income greater than financial income in this period. That's going to be a tax asset, a deferred tax asset, right? But taxable income being less than financial income, that means we're going to have a deferred tax liability, aren't we? Right? So I would create a chart. You know, if you can't, sometimes what I do is I have scenarios in my head. Deferred taxable income greater than financial income. You know, I know, okay, I'm paying more taxes now than I'm going to down the road. So I'm going to have an asset. I'm paying more than what the financial books show. It's going to be an asset. But if I'm paying less in taxes today than what the books show, I'm going to have a liability on the books because I know I'm going to need to be paying it. Discuss why permanent differences do not impact future tax periods and how these differences affect tax rates. So we know ultimately that permanent differences result in expenses or revenues that never are going to hit the taxable income or never going to hit the financial income. Permanent differences never reverse and do not require interperiod income tax allocation. Okay? They're ultimately going to affect the effective tax rate because our tax rates are determined what's taxable income. Isn't that correct? Do you guys have any questions on this before we move on? Let's do 1813. This is very similar to the problem. Okay? How are we doing? Do you guys need a break? Do you want to take a 5-minute break? Okay, let's take a 5-minute break. Then we'll start up again.